Welcome back to Force Education. This is Ed. Today we're going to be talking about Aurora Cannabis. And this company here, or ACB, is a Canadian company that really deals with cannabis or cannabis products. So the name kind of tells what it is. It has received a massive drop of around 40%. And when you think about it, when you take a look at the 52-week high, it was around 1064. Currently, it's sitting at 168 and it's a new 52-week low. So it kind of grabbed my attention to kind of wonder what's happening with this company and why did it drop that much significantly compared to its previous downfall. So you get to see more of a massive drop, especially since it was kind of trying to bounce above that channel kind of line or the wedge in sense. And it had a good chance of actually breaking out. And then you see it drop down towards the bottom of the channel. So the question is, what is going on? We kind of will get to understand a little bit about ACB, and perhaps you might consider, if you're not in it, you might consider getting in it, and if you're in it, you might consider getting out. So hopefully that gives you more information to kind of make an educated decision. So one of the latest news here, and this is the first thing you get when you enter their website, it's Aurora to acquire Thrive Cannabis, including award-winning brands Greybeard and Being Cannabis. Now the company here is a pioneer in global cannabis dedicated to helping people improve their health, wellness, and lives. So they're prioritizing health and safety in general, and they're optimizing growth conditions for a highly automated Sky-class facilities across Canada and Europe. So since 2013, their strength in research and product innovation, they have continually pushed industry standards forward throughout the facility or art facility engineerings, cannabis breeding, research industry, leading products, developments, creating brands that break through whenever they are launched. Now they have different medical brands. So this is kind of for medical cannabis in general for patients, and it could be more of marketing in general, how different they are, but they do generally say what they're actually mainly used for and how it affects your body, that kind of stuff. It depends on the variety, of course, of the cannabis and the species itself. So they have CanniMed, MedReleaf, plus Aurora, and WMMC. And they got consumer brands as well, and this is, I believe, for recreationals. So you got San Rafael, Daily Special, Aurora Drift, Whistler, Cannabis Co., AltaVie, and Woodstock. Now, they have been in the US market for quite a bit, and I've seen this sticker going on from a lot of different places in general. Now, the price of her book is around 0.44, and the price of her sale is around 2.14. So right off the bat, you get to see that they're heavily undervalued. But the question is, are these updated metrics? And we're going to discuss that in a second. In terms of financial strength, it still looks good. I mean, debt from equity is 0.36 and debt from assets around 0.25. That might be a little bit off, but overall, you get to see that it's heavily shorted, 12.62. I mean, I consider that heavily. It's really subjective into what you consider heavily. And I do remember back in 2020, we've seen ones that go up to 60 or even 100% of the float. But profitability, you get to see that it's not really a profitable company when you look at 2021. In management effectiveness, not so well as well. Negative 59, negative 55, and negative 75 for return on capital, assets, and equity, respectively. Now, if you were to compare it with another company, let's say drop something like Hexo, and Hexo is another cannabis company, you get to see the price over sale is 0.72 and the price over book is 0.25. And you get to still see that the management effectiveness is actually worse, but things generally like financial strength are a little bit closer and a short interest as a percentage of float. So there could be more of an issue in general in the industry itself and how these things are valuated. They're definitely not valuated as tech. But you get to see a company like, for instance, SNDL, their price over book is around the same, but it's highly overvalued on price over sales than both the last two that we talked about. And that is really depending on the metric that you actually follow, because ACB, for instance, has better management effectiveness and profitability than Hexo, but worse than SNDL. But generally, price over sales and price over book looks better than SNDL. So it's really what you're looking at. For me, I like a bit of a mix. I try to look at all, but currently you get to see that ACB dropped a little bit down, and I'm not sure if that's justified. So a quick thing about what ACB is. So they have different branches. I'm not going to spend so much on this presentation, but they got Canadian Medical, International Medical, Adult Recreational, and Science and Innovation. And they had basically a different margin or adjusted gross margin, and you get to see that they're leading. And next in line comes Hexo, and that's why I kind of gone through it. But their direct-to-patient business model in Canada for medical markets allows for additional margin captures versus Canada's adult recreational market. So that's one of the things that they focus on. They're number one in Canadian medical share by revenue, and 63% adjusted gross margin achieved in the full year 22 for quarter three, and 79% of revenue came from high value insured patients in quarter three as well. So you get to see that medical is a big part of what they do as well. And significant investments in technologies and fulfillment infrastructure provides barrier for entry for competitors and high retention rates in key patient groups. So they really try to cater for a specific amount of people or specific type of people, and they really try to maintain and grow that kind of customer base in general, consumer base. Now, here they kind of show you what their markets are. For instance, Canada, Germany, France, Netherlands, Australia, UK, Israel, and Poland. Now, they have different hemp-derived CBD products, and that is a significant and growing market. And you get to see here whether it is oils or gummies or whatever it is, that is a growing market, and they're definitely looking to grow into that. Now, they also have put some gross margins differences, and of course, they will show you the ones that are underperforming compared to theirs. We're just going to try to be a little bit unbiased, but ACB, hands down, still has a lot of different metrics that are better than some of their competitors. And you get to see some of their brands as well, and basically what their formats are available or what their upcomings are. And it goes anywhere from capsules to edibles to oils to hash to strips to pre-rolls, vapes, edibles, whatever it is, flour, all that kind of stuff. They are entering into that market or have entered into that market at that point under different brands. Now, the key takeaways here, their transformation plan is on track, so they're expected to achieve a positive EBITDA for the full year of 2023, and they're targeting a total of $150 to $170 million of annualized savings throughout the first half of 2023. And their medical leadership, they're number one in Canada, and growing international segments revenue was up 55% for the full year 22 quarter three compared to last year. Now, considerably improved the balance sheets, approximately $314 million of cash and cash equivalents as of May 11th, an early repurchase of $141 million in convertible debt, and they have $887 million still available under shelf perspective for future financing and potential strategic acquisitions. Now, Sign's innovation program, launch of 6 new cultivators from breeding program for full year 22 quarter 4, and hold the foundational intellectual property rights to cannabinoid biosynthesis. So that's science and innovation. So we kind of have an idea. I'm not going to go again through the balance sheet because you still have the full year, but you get to see they had a 22% loss, a loss of $9 million versus quarter 1 2022. So they improved by 22% for their adjusted EBITDA. Now, this news is what apparently have made it drop quite a bit. Aurora Cannabis announced upsize to previously announced bought deal. Now, this is a financing deal, and they're basically adding in at a price of $2.45 per unit for gross proceeds of approximately $150 million. This is still technically an offering, and it's at $2.45. Now, of course, there is discounts related to that, but you get to see the current price is $168, so it's lower than what they're offering at. And that seems to be something that a lot of companies do when they raise a lot of money like that anyway. But you get to see that in general in retail, some people are not really happy about basically the massive raising of money relating towards that offering. But others are saying, hey, this is below even cash value, so might as well go in it. But you got to keep in mind, with these offerings, sometimes new shares are issued as a part of the deal and whatnot, and they're selling new shares, and that kind of dilutes the price in general. But currently they're selling it at $245. Even if you assume 100% discount around $120, it's not far off from the $168. And that 50% is a bit generous in terms of a discount. But it's currently, I believe, it's a bit of oversold. And we're going to take a look at technical analysis quickly before kind of discussing it a little bit further. But if you'd like to see more contents like this, make sure to click the subscribe button on the bottom right corner and leave notification buttons on for this channel, and don't forget to drop a like. If you'd like to join our Discord, you can do so in the description below, and let's move on to that. Now, from a technical analysis point, I can go on with different technical indicators, but with a massive drop of around 40%, almost everything will basically show whether it's bearish, like MACD going negative, momentum being on the negative side, and the ADX showing that this might be a trend. Basically, you have to understand what happened, and the offering part definitely did not help it, and that was the main cause. People were panic selling. Rather than it was a massive negative news. I mean, dilution in general and offerings are somewhat of negative news in general when a company dilutes the amount of shares. But when you already drop 40%, the question is, do you want to sell a 40% less? I mean, that's literally just got priced in during the day, kind of, in my own opinion. But you get to see on the willing percent R, which is very, very similar to the relative strength index, it's highly oversold at around 96%, which basically shows that this one has definitely been subject to panic selling. Now, in terms of stochastic fast and stochastic slow, they're both going downwards, saying be careful here, you might hit a new low, and we did. So it's currently no news really. Now, in terms of volume was massive. 110 million at 162. That's a lot of money going around. Well, millions, or more than $100 million, almost $200 million being traded on the last day. So that is significant. Now, some of that, granted, was selling, some of it was buying. It's not the record volume, though. The record volume was back in 5th of November, I believe, or around 6th of November, when they had almost $500 million, or $500 million in terms of shares, trading at 10 to 12. That was billions of dollars. So in all kind of retrospect, it does look like a smaller move when you compare it to previously, but it's still a significant volume. Now, I can go back to different volumes, and I can go all the way back, and you get to see where it was 150 pre-split, of course, or it being around 21 after the split, and where we're at right now, but I'm only going to consider the last 6 months. Fibonacci retracements, you're able to see significant resistance at 285, 362, 423, 485, 578, and 685, with a support at 162. Now, there is currently that level, 162 as a support. The next big resistance would be 221, 257, going higher to 279, 311, 323, and then 343, 371, and 399, going to 421. Now comes to the question to what I think about this one and what's going to happen. Well, I do think that we might actually very strongly see a balance in the coming week or so, especially that a lot of people that have known ACB and seeing it at this price, it almost looks like a steal. Now, granted, there was dilution, but you got to also consider how much money they have as cash and the new amount of shares. And their current growth rate is a big question. But just be careful, because if you want to put some money in it, just be kind of in the mindset that you can easily lose it in terms of over longer term. And that's true with almost any stock. You get to see here, for instance, 150 pre-split or after split, where it was around $19 or $20. People or folks that bought around $20 currently have lost almost all their money when it's on 162. Keep that in mind. Well, it is the 52-week low, and actually I think all-time low when you consider the splits and whatnot. But keep in mind that it could be a good time to buy for a short-term period or a medium-term period, rather than leaving it for generations to come. But I could be completely wrong, and I do hope I'm wrong in terms of long-term profits being multiples, but it is right now. What do you think about this ticker? Thanks for mentioning down in the comments below. Sure, subscribe and like, and have a wonderful day.